Bitcoin doubled in just 1 year. By July 2025, it shot up from $60,000 to over $115,000. 100% gain, while most people just watched, hesitated, or kept telling themselves the party was over. Still, maybe you feel like you missed out. Or you wonder, do you need to take wild risks to win? Is the next wave coming? Or are you too late? If you're asking those questions, you are in exactly the right place. We'll pull back the curtain on how the world's biggest players, BlackRock, Fidelity, Grayscale, MicroStrategy, are taking control. I'll show you where even smart investors trip up, with real-world quotes and hard data. And most importantly, I'll explain why the biggest moves always happen before the headlines. Stick around, and I'll show you how to act calmly, not just chase FOMO. Ready? Let's dig in. You know those months when Bitcoin just grinds sideways and nobody's talking about it? That's when the giants get to work. Right now, BlackRock holds about 700,000 Bitcoin, 3.3% of the total supply, and wants even more. Fidelity? Massive. Grayscale? Still one of the largest ETF pools on Earth. MicroStrategy? Over 1% of all Bitcoin, with a reputation as the ultimate leverage play. Together, these names and a handful of other giants control over 3 million Bitcoin. But why are these players quietly stacking Bitcoin? 3 reasons: supply, strategy, and timing. First, scarcity. Only 21 million Bitcoin ever. Some are gone forever. When it's quiet, big buyers can grab huge amounts without moving the price or sparking a rush from the crowd. Second, timing. Every monster Bitcoin rally starts after months of sideways action, as the foundation gets laid by ETFs, stablecoins, and macro trends most people never see. The pros want to be in before that tidal wave of new money arrives. If they wait for headlines, they're too late. Third, strategy. For institutions, Bitcoin isn't just a trade. It's a hedge against inflation, a buffer against fiat risk, a strategic bet that the global system could wobble. Quiet accumulation builds a war chest before Bitcoin gets fully priced as digital gold. And the data backs it up. Whenever the market is quiet, whale wallets and ETF addresses keep growing. Small holders fade out. The giants always move first. The headlines, they come later.
So why should you care about all this behind-the-scenes accumulation? Because right now, we're seeing a tidal wave of new money entering the system. Billions of dollars every single week. Stablecoins, ETF inflows, new lending options. Every major exchange and brokerage is making it easy to buy, to borrow, to use margin, even to take out a loan against your Bitcoin. And when that much money meets a cap supply, prices don't just drift up, they rocket. But remember, after every rocket ride, there's always a crash. Is this new? Not at all. Every huge Bitcoin bull run and every nasty crash has started with the same recipe: new money, easier access, and a surge in leverage. Just look at 2017. That year, platforms and margin trading went mainstream. The price soared from 1,000 to nearly 20,000, then crashed by more than 80% once the party stopped. Or take 2020 and 2021. After the COVID crash, global liquidity exploded. Institutions bought through Grayscale, new funds launched, stablecoins surged, and retail money poured in through apps and crypto lenders. Bitcoin raced from $10,000 to $69,000. And then, as soon as the headline soured and leverage unwound, it tumbled all the way back to 16,000. Same mechanics every time. New ways to buy, new inflows, then a parabolic run. But the crash always comes, triggered by regulation, profit-taking, or sudden outflows. And now, with ETFs live in the US and worldwide, instant stablecoin swaps, and over $1 billion a day hitting Bitcoin markets, the stakes are even higher. Whenever new tools make exposure easier, ETFs, margin, futures, or instant cash rails, the story repeats. Easy money,
supply squeeze, mania, then panic. If you know this pattern, you won't be surprised by what's next.
So, what's the upside this time?
Let's get specific. Standard Chartered predicted in June 2025 that Bitcoin could hit $150,000 by early next year if ETF inflows and global demand keep up. Fidelity's research puts a strong case target at $200,000, especially if we see a supply shock from ETFs and big corporate buyers. Even JP Morgan's analysts have floated the idea of $200,000 if the current momentum holds. And if the giants, BlackRock, Fidelity, the rest, get their wish and end up holding 7 to 10% of supply, we could see a $2 to $3 trillion Bitcoin market cap. That would put the price well above $200,000 per coin. Of course, nothing's promised. But the most aggressive forecasts in past cycles, once considered crazy, often ended up being too conservative. Those big runs happened before the headlines, when liquidity was surging and the crowd was still on the sidelines.
With all this attention, how should you actually invest? Let's make it simple.
If you want the easiest route, Bitcoin ETFs are your best bet. BlackRock's IBIT is the world's largest spot ETF, low fee, and tracks Bitcoin tightly. Fidelity's FBTC is right up there, with top-notch security. Grayscale's GBTC is a crowd favorite too, though it sometimes trades at a premium or discount. Why pick an ETF? Thoughtful. Convenience. Any brokerage. Regulated. No passwords to lose. The trade-off? You pay small annual fees and you don't really own the Bitcoin. It's held for you. Want more upside and more risk? Look at the Bitcoin-heavy stocks. MicroStrategy is the classic leverage play, often swinging 2 to 3 times as much as Bitcoin in either direction. Coinbase rises and falls with crypto trading volume, not just Bitcoin's price. For a real roller coaster, miners like Riot, Marathon, and CleanSpark can skyrocket or crash even harder. And if you want ultimate control, nothing beats owning Bitcoin directly. Buy it, keep it on a hardware wallet like Ledger or Trezor, and it's all yours. No counterparty risk. But lose your keys and your Bitcoin is gone for good. So, which is best? If you want simple, stick with ETFs. If you want high potential and can stomach high risk, add in the Bitcoin-heavy stocks. If you want sovereignty, hold Bitcoin yourself. Or mix and match. Just know the higher the upside, the bigger the crash when the music stops.
Now, let's talk psychology.
Every cycle, it's the same old story. People watch from the sidelines, price moves. Suddenly, everyone is talking about Bitcoin at the top. That's when the crowd piles in and the early buyers quietly start taking profits. Howard Marks, legendary investor, nailed it. The biggest investing errors come not from factors that are informational or analytical, but from those that are psychological. Peter Lynch put it bluntly, far more money has been lost by investors preparing for corrections or trying to anticipate corrections than has been lost in the corrections themselves. This isn't just theory. In April 2021, Glassnode showed that long-term holders were selling their Bitcoin to a wave of new retail buyers, right at the top. Same thing happened at every previous peak. Coinbase's own research said it. Funds and ETFs start distributing coins when social interest and Google searches for Bitcoin peak. Even this year, JP Morgan's strategist Nikolaos Panagiotsoglu said, most retail inflows arrive only after the initial rally, when early institutional buyers are already reducing exposure. It's always FOMO, then greed, then panic. Winners are the ones who spot the trap and act with conviction, not emotion. If you can do that, you're already ahead of most investors.
Of course, not everyone thinks this ends with new highs. Plenty of smart people think the bubble could burst any day now. Their reasons? Leverage is back, big time.
A small drop could trigger a chain reaction of forced selling, just like every past crash. And don't ignore ETF outflows. We've seen billions leave Bitcoin ETFs in just days, dragging down price and shaking confidence. Whew. When ETFs bleed, so do stocks like Coinbase, MicroStrategy, and all the big miners. In fact, in every previous crash, these stocks fell even harder than Bitcoin itself. Add in the on-chain warning signs, long-term holders quietly taking profits, a pattern that's marked the start of every major top. And the macro risk. What if global liquidity dries up, the Fed turns hawkish, or governments roll out new regulations? Suddenly the party could end. Fast. But here's the hard truth. Every mania ends with a crash. The question isn't if, but when, and who's left holding the bag. The real skill isn't guessing the top, it's understanding the cycle, so you're never the last one in or the first one out. So while the crowd chases excitement or waits for the perfect moment, the smart money is already running the numbers and preparing for both sides of the cycle. This 8-month window might just be the last easy phase before the next mania or the next crash. It's not about gambling. It's about understanding the rhythm of markets, acting with conviction, and not getting swept up in the noise. History never repeats perfectly, but with Bitcoin, it sure does rhyme. The real winners, they stay calm when others panic and see opportunity where the crowd only sees fear. And look, Bitcoin isn't the only game in town. If you want to see where the next real disruption could be, beyond just Bitcoin price charts, pay attention to what's happening in stablecoins and digital money infrastructure. That's why I strongly recommend my next video, Why Circle is the most important company of 2025. You'll see how a company that survived a $60 billion crypto collapse is now at the center of the new digital economy, and why the next 600% gain might come from understanding new power shifts, not chasing the old playbook. Want to get ahead of the next trend before the crowd even sees it? Click through and join me. Your edge as an investor starts by looking where others aren't. And this is a story nobody serious about the future of money should miss. The smart money doesn't wait for confirmation. They act when things are quiet, when nobody's watching. That's how you get ahead, not by chasing, but by positioning, by understanding what's moving the game before it's obvious. You don't have to be perfect, you just have to stop making the same mistakes. Buying at peaks, selling in fear, ignoring cycles. This isn't about timing the top, it's about surviving the ride. The biggest moves in crypto don't come from luck. They come from preparation, from being early, from spotting structure in the chaos. That's the whole point of this channel, to help you see clearly. So whether Bitcoin goes to $200,000 or crashes to $40,000, you'll be ready, calm, clear, focused, not frozen by fear or whipped around by hype. That's what separates investors from spectators. Thanks for watching. If you found this helpful, share it with someone who's just getting started. See you in the next one.